Look, I need you to understand something right now. While everyone's distracted by holiday shopping and year-end bonuses, something's happening in the financial markets that's going to catch millions of retirement savers completely off guard. And the window to prepare is closing faster than most people realize. Let me paint you a picture of what's unfolding right now. Gold just crossed $4,000 an ounce. Think about that for a second. Just 21 months ago, it was trading at $2,063. That's a 94% increase in less than 2 years. But here's what nobody's talking about. This isn't just a bull market. This is the beginning of a fundamental restructuring of how wealth is stored and protected globally. You know what keeps me up at night? It's not the people who are paying attention. It's the folks who have their entire retirement sitting in traditional accounts, watching their statements, thinking everything's fine because the numbers keep going up. They don't realize those numbers are denominated in a currency that's losing purchasing power faster than their account balance is growing. Let me tell you about something that happened in 1971. Most people don't know this story, but it's absolutely critical to understanding what's happening right now. On August 15th, President Nixon closed the gold window, ended the Bretton Woods system. Suddenly, the dollar wasn't backed by anything except faith in the U.S. government. And you know what happened to gold? It went from $35 an ounce to $850 by 1980. That's a 2,400% increase in 9 years. But here's the part that haunts me. The people who saw it coming, who moved even a portion of their wealth into hard assets, they preserved their purchasing power. The ones who didn't? They watched inflation eat away at their savings, while their dollars bought less and less every single year. Now, I'm not saying we're in exactly the same situation, but I am saying the parallels are impossible to ignore. Central banks around the world are buying gold at the fastest pace we've seen in decades, not selling, buying. And these aren't small purchases. We're talking about hundreds of tons. The People's Bank of China has been accumulating month after month. The Reserve Bank of India is stacking. Poland, Hungary, Singapore, countries that understand what's coming are moving aggressively into physical gold. You have to ask yourself, why? These are the most sophisticated financial institutions on the planet. They have access to information and analysis that you and I will never see. And they're choosing to convert their paper reserves into physical metal. What do they know that the average retirement saver doesn't? Here's where it gets really interesting. The COMEX, the major commodities exchange where gold futures are traded, has been showing some unusual patterns lately. The ratio of paper gold to physical gold has been expanding. There are more claims on physical metal than there is actual metal available for delivery. It's like a game of musical chairs, except when the music stops, most people are going to find out their gold was never really there. I want you to think about your retirement account for a moment. How much of it is in stocks, bonds, money market funds, all paper assets, all denominated in dollars, all subject to the same systemic risks that are building in the financial system right now. And I'm not trying to scare you. I'm trying to wake you up to what's happening in plain sight. The Federal Reserve has been playing a dangerous game. They printed trillions of dollars over the past few years. Trillions. That money didn't just disappear. It's sitting in the system, slowly working its way through the economy, pushing up prices on everything from groceries to housing to healthcare. Your retirement account might show bigger numbers, but what can those numbers actually buy? Let me share something with you. There's a concept in economics called real returns versus nominal returns. Nominal returns are what you see on your statement, the percentage your account went up. Real returns are what you get after you subtract inflation. And here's the brutal truth. For most people, their real returns over the past few years have been negative. Their accounts went up, but their purchasing power went down. Now, I know what some of you are thinking, but the stock market's been doing great. My 401k is up. And yes, in nominal terms, that's true. But let me ask you this. Have you tried to buy a house lately, or a car, or even just fill up your grocery cart? Those dollars in your retirement account buy less than they did a few years ago, and the trend is accelerating. Here's something most financial advisors won't tell you. The traditional 60-40 portfolio, 60% stocks, 40% bonds, that model was built for a different era, an era of stable currencies and predictable inflation. We're not in that era anymore. The rules have changed, but most people are still playing by the old playbook. Central banks understand this. That's why they're diversifying into gold. They're not abandoning their other assets, but they're adding a foundation of hard assets that can't be printed, can't be devalued by monetary policy, and have held value for thousands of years. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical gold into your retirement account without triggering tax penalties or early withdrawal fees, worth checking out if you're thinking about adding some protection to your portfolio. Anyway, let me tell you about what happened in 2008. When the financial crisis hit, people watched their retirement accounts get cut in half. Stocks crashed, bonds struggled, real estate collapsed. But gold? Gold went from around $700 an ounce to over $1,900 by 2011. The people who had even 10 or 15% of their portfolio in physical gold had a cushion that protected them when everything else was falling apart. And here's what's different now. Back in 2008, the problem was too much debt in the private sector. Banks had made too many bad loans. This time, the problem is government debt, sovereign debt, the kind of debt that can't be solved by bailouts because governments are the ones who need bailing out. And when governments get in trouble, they have one tool they always use: they print money. And when they print money, the value of every dollar you own goes down. Look at what's happening with the BRICS nations: Brazil, Russia, India, China, South Africa. They're actively working to reduce their dependence on the dollar. They're setting up alternative payment systems. They're trading in their own currencies. They're accumulating gold as a neutral reserve asset. This isn't conspiracy theory stuff. This is official policy that they're announcing publicly. The dollar has been the world's reserve currency since World War II. That status has given the United States enormous advantages. We can print money and export our inflation to the rest of the world. But that system is under stress like never before. And if the dollar loses its reserve status, even partially, the implications for American savers are profound. Think about it this way. Right now, there's demand for dollars all over the world because countries need them to buy oil, to trade with each other, to hold as reserves. That demand keeps the value of the dollar higher than it would be otherwise. But if that demand decreases, if countries start using other currencies or gold for international trade, there are going to be a lot of dollars coming back home. And when the supply of something increases while demand decreases, the price goes down. In this case, the price of the dollar, its purchasing power, would decline. Now, I'm not saying the dollar is going to collapse tomorrow, but I am saying the trend is clear. The world is slowly, methodically moving away from a dollar-dominated system toward a more multipolar system. And in that transition, hard assets like gold and silver become increasingly important. Let me tell you about the London Bullion Market Association. This is where the big players trade physical gold. Not paper contracts, but actual metal. And the premiums on physical gold, the amount you pay above the spot price to actually get your hands on real metal, those premiums have been elevated for months. That tells you something important. It tells you that demand for physical gold is outstripping supply. People don't just want exposure to gold prices. They want the actual metal. There's a reason for that. When you own paper gold, ETFs, futures contracts, mining stocks, you have counterparty risk. You're depending on someone else to honor their obligation to you. But when you own physical gold, there's no counterparty. It's yours. It's in your possession or in secure storage under your control. And in times of financial stress, that difference becomes critical. I want to share a story with you. Back in the 1970s, there was a man named Harry Browne. He wrote a book called You Can Profit from a Monetary Crisis. In it, he recommended that people put a portion of their wealth into gold as insurance against currency devaluation. People thought he was crazy. Gold was for doomsday preppers and conspiracy theorists. But then inflation hit, double-digit inflation, and the people who had followed his advice, who had bought gold at $35 or $50 or even $100 an ounce, they preserved their wealth while everyone else watched their savings evaporate. The lesson isn't that you should put everything into gold. The lesson is that diversification means more than just owning different stocks. It means owning different types of assets, assets that respond differently to different economic conditions. And gold has historically been the asset that performs best when confidence in paper currencies declines. Here's something that should concern every retirement saver. The average 401k is heavily weighted toward stocks. That's not necessarily bad when the economy is growing and corporate profits are rising, but what happens when we hit a recession? What happens when corporate earnings decline and stock prices fall? Your retirement account takes a hit, and if you're close to retirement, you might not have time to recover. But it's not just about protection. It's also about opportunity. Gold is in a secular bull market. That means the long-term trend is up. Yes, there will be corrections and pullbacks along the way, but the fundamental drivers, currency debasement, geopolitical instability, central bank buying, supply constraints, all of those factors are pushing gold higher over time. Think about the supply side for a moment. Gold is getting harder and harder to mine. The easy deposits have been found. New discoveries are rare. Production costs are rising. And it takes years, sometimes decades, to bring a new mine online. Meanwhile, demand is increasing. Not just from investors, but from central banks, from jewelry markets in Asia, from industrial applications and technology. When supply is constrained and demand is growing, prices have to rise. It's basic economics. Now let's talk about silver for a second, because silver is an even more interesting story. Silver has all the monetary properties of gold. It's been used as money for thousands of years. It's scarce, it's durable, but it also has industrial applications that gold doesn't have. Solar panels, electronics, medical devices, water purification. Silver is essential to modern technology. And unlike gold, silver gets consumed. It gets used up in industrial processes and isn't economically recoverable. The gold to silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, has been historically around 15 to 1. Right now, it's much higher than that, which means silver is undervalued relative to gold, and when that ratio reverts to its historical mean, silver prices could move dramatically. But here's what keeps me up at night. It's not just about making money or protecting wealth. It's about the people who are going to get hurt because they didn't see this coming. The retirees who are going to find out that their fixed income doesn't cover their expenses anymore because inflation has eaten away at their purchasing power. The workers who are going to discover that the retirement account they've been contributing to for 30 years doesn't provide the lifestyle they were promised. I'm not trying to be dramatic. I'm trying to be realistic. The financial system we have today is built on debt and leverage and the assumption that growth will continue forever. But what happens when growth slows? What happens when the debt becomes unsustainable? What happens when confidence in the system starts to crack? That's when people remember why gold has been valued for 5,000 years. It's not because of some arbitrary tradition. It's because gold is the ultimate form of money. It can't be printed. It can't be devalued by government decree. It doesn't depend on anyone's promise or guarantee. It just is. And here's the thing about insurance. You don't buy it after the disaster happens. You buy it when things seem fine, when the sun is shining and everything looks stable. Because by the time the storm hits, it's too late. The premiums are too high, or coverage isn't available at all. That's where we are right now. Things seem relatively stable on the surface. The stock market is near all-time highs. Unemployment is low. But underneath, the stresses are building. Government debt is at levels we've never seen in peacetime. The Federal Reserve's balance sheet is bloated with assets they can't easily unwind. Geopolitical tensions are rising. The global monetary system is under strain. Smart money is preparing. Central banks are preparing. Institutional investors are preparing. The question is, are you preparing? Let me tell you what preparation looks like. It doesn't mean selling everything and buying gold bars. It means taking a clear-eyed look at your retirement portfolio and asking yourself, am I adequately diversified? Do I have assets that will hold value if the dollar weakens? Do I have protection against inflation? Do I have something that will perform well in a crisis? For most people, the answer to those questions is no. They have stocks and bonds and maybe some cash, all paper assets, all denominated in dollars, all subject to the same systemic risks. Adding physical gold to your retirement account isn't about being pessimistic. It's about being realistic. It's about understanding that the financial landscape is changing and positioning yourself accordingly. It's about having a foundation of real assets that have held value throughout human history. Think about what gold represents. It's portable wealth. It's universally recognized. It's accepted everywhere in the world. It's been money longer than any currency currently in existence. And it's one of the few assets that has no counterparty risk. When you own physical gold, you own something real, something tangible, something that can't be erased by a computer glitch or a bank failure or a government decree. The countdown I'm talking about isn't to some specific date or event. It's the gradual erosion of the dollar's purchasing power. It's the slow-motion crisis that's unfolding as governments around the world grapple with unsustainable debt levels. It's the transition from a unipolar financial system to something new and uncertain. And here's the brutal truth. Most people won't act until it's too late. They'll wait until gold is at $5,000 or $6,000 or $8,000 an ounce. They'll wait until the crisis is obvious to everyone, and by then, the opportunity to protect their wealth at reasonable prices will be gone. I've been studying markets for years, and one thing I've learned is that the crowd is almost always wrong at major turning points. When everyone is bullish, that's when you should be cautious. When everyone is bearish, that's when you should be buying. And right now, most retirement savers aren't even thinking about gold. They're not worried about currency debasement or monetary instability, which tells me this is exactly the time to be paying attention. The institutions that manage trillions of dollars, they're not waiting. They're acting now. They're diversifying into hard assets. They're reducing their exposure to paper currencies. They're preparing for a world where the old rules don't apply anymore. You have a choice to make. You can ignore what's happening and hope that everything works out. You can trust that the system will continue to function the way it has for the past few decades. Or you can take responsibility for your own financial security and make sure you have some protection in place. I'm not telling you what to do. I'm just laying out the facts as I see them. Gold is at record highs and still climbing. Central banks are buying aggressively. The dollar's reserve status is under pressure. Inflation is eroding purchasing power. Government debt is at unsustainable levels. These aren't opinions. These are observable facts. The question is, what are you going to do about it? Are you going to wait and see what happens? Or are you going to take action while you still can? Because here's the thing about countdowns. They don't stop. They don't pause. They just keep ticking down, second by second, until time runs out. And when it comes to protecting your retirement, the time to act isn't when the crisis is obvious to everyone. It's now, when you still have options, when you can still make rational decisions without panic. The people who protected their wealth in past crises weren't the ones who had perfect timing. They were the ones who understood the risks and took reasonable steps to prepare. They didn't try to predict exactly when or how things would unfold. They just made sure they had some insurance in place. That's all I'm suggesting. Not that you abandon your current strategy, not that you make radical changes, just that you consider whether you have adequate protection against the risks that are building in the system. Whether you have some exposure to assets that will hold value when paper currencies are under stress. The countdown is accelerating. The signs are everywhere if you know where to look. The question is whether you're going to act on what you're seeing, or whether you're going to wait until everyone else figures it out too. Your retirement is too important to leave to chance. The decisions you make now, in this moment, could determine whether you have financial security in your later years or whether you're struggling to make ends meet. That's not meant to scare you. It's meant to motivate you to take this seriously. Look at the data. Look at what central banks are doing. Look at what's happening with currencies around the world. Look at the trajectory of government debt and monetary policy. And then ask yourself, am I positioned for what's coming? Or am I hoping that somehow things will just work out? The choice is yours, but the countdown isn't stopping. And every day that passes is one less day to prepare for what's ahead.